What type of mortgage to flip a house? Looking for a mortgage to flip a house? Here's the truth. Most mortgages won't work. I'll show you which loans are built for flippers and which will kill your deal before it even starts. In this video, I'm going to break down the difference between traditional mortgages and the financing that real flippers actually use. You'll know which loan options actually work for flipping and why most mortgages aren't designed for this strategy. Can you get a conventional loan from a lender to flip a house? Yes and no. On the very first deal that we bought to flip back in 2007, we were able to use a conventional loan. We had good credit, and there was a program called a no-doc loan. So as long as you had good credit, you didn't have to verify any income. And I believe we had 97% of the purchase price financed, because again, loans are really easy to get back then. Now, what we didn't have was any money for the renovations of the project, so we had to come up with that money ourselves. We cover strategies like that in a lot of other videos on our channel, so be sure and check them out. But what's the problem with conventional loans? Number one, almost always they're gonna want it to be an owner-occupied property. Now you can say, hey, how will they know? Well, they may not. But here's the problem. If they do, you could face jail time and a large fine. So be very careful if you decide to go down that road. I would not advise that. Conventional loans are also slow to get. It'll take you usually up to 60 days to close on that. And they're very particular about what they will loan on. If you're trying to buy a house to flip, there's a good chance that house needs some repairs, right? And if they don't like the repairs that are needed, or it doesn't fall into their parameters for a loan, they will deny you that loan based on the property. So it can be very difficult to get a conventional loan. And the truth is, those loans are designed for long term. You might say to yourself, but Glenn, I can get a rate at 5 or 6%. Well, that's based on a long-term loan. You need this for a very short amount of time. So it might make more sense for you to have a short-term loan with what's called a hard money lender. But I'll cover that in just a minute. You can get an FHA mortgage or a VA mortgage, but the truth is, they are definitely not great for flips because they are much more picky about what types of houses they will lend on. As a matter of fact, FHA loans can get so picky that if you have paint flaking around a windowsill, you have to have that painted before they will give you money on the property. So they can get really particular and make it very difficult to buy a property that's actually a good flip for you. Yes, they'll cover almost 100%, but they don't cover 100%. You could get a USDA loan, and those do cover 100%, but again, come with their own set of guidelines. So those mortgages are not ideal when buying a house to flip. So let's go back to hard money loans. Hard money loans sounds like you're borrowing money from someone out of the movie Goodfellas in the back of their trunk. And the truth is, that's not what it is. These are groups of people that say, listen, we're not a bank. We don't want to tie up our funds for 30 years like a bank does. We want to tie up our funds for 6 months or 12 months. Now you're going to pay us 10, 12, or 15% for the amount of time that you use that money, but we're willing to risk our money on you because you're a higher risk. You're going to flip a house that may not hold the value because we're going to loan you money for not only the purchase price, but we're going to also loan you money for the renovation costs. That's where it gets beautiful. Now, will they put a mortgage on the property? Yes. They will put a mortgage on the property for the amount of money that they loan you. So you're not able to sell that house to anybody else before you pay off that mortgage. And let's just clarify, a mortgage is very simply a legal document that ties a money or financial obligation to a piece of property. So once a mortgage is on a piece of property, that means that you can no longer sell that house without paying that loan or that mortgage off first. That's what a mortgage is. We cover details on a lot of hard money loans and ways to structure that on our channel. So again, please be sure and check that out. But for this video, I want you to understand that they are possible and they are fast. You can usually get financing from a hard money lender in a week or two. You don't have to wait 6 weeks or 2 months to get financing. You can literally get your financing in a couple of weeks, sometimes in less than a week if it's a really good deal. They are far less picky about your credit and on the property. Now, your credit is a factor. You can't be a complete deadbeat and not have paid your bills for years and be in an active bankruptcy. If you have a credit usually in the high 500 range as a minimum, they like to see you in the 600 range, or obviously 7 is going to be better. But the better your credit rate, usually the better rate that you'll pay because you're less of a risk for them. But your credit is a factor. What the real factor is the property. If you don't have great credit, let's say you have a 585 credit score, and you're somebody who's repairing your credit, let's just say that. You're repairing your credit. And you find a deal that you can buy at 50% of value. And you're buying a house for $100,000 that's going to sell for $300,000 when you're done. To a hard money lender, they're licking their chops because they're protected on that deal. So they will be much more apt to loan you money even if your personal credit is not great because the deal is solid. They can place their mortgage on that deal and feel like even if you default, they could sell that property as is and still get their money back. Does that make sense? Here's some other alternatives. There are loans called DSCR loans, debt service coverage ratio loans. They are loans that lenders will make. They are hard money lenders for the most part, but they look at the property as a whole. Usually this is going to be if you're going to buy a rental property. They'll say, wait a minute, so we're going to come in and say, we're going to loan you money on this based on the fact that you're going to have income coming in. If the income for this property covers the debt, so debt service coverage ratio, if the income covers the debt with what's called a 1.2% ratio, then as a minimum, then they will loan you money on that property. And so your credit, again, is a factor, but is not the main factor on that deal. That's called a DSCR loan. And lastly, my favorite, are private lenders. Now, we stumbled onto private lenders many years ago because when we started in 2007, we took conventional loans for our very first 2 deals. And then I had 2 flips under contract. And if you remember 2008, it was one of the worst times in American history in the financial industry. That's when major companies were shutting down and banks were shutting down. And they shut down all of our lender programs. I remember saying, uh-oh, I'm in trouble. And I had to reach out to some people I know and say, would you mind loaning me some money so I could do this deal? Once I showed them the deal and showed them I was going to pay them 14% interest on their money, I started getting private lenders. My first private lender didn't even have cash. She used her home equity line of credit to loan us money. I paid her payment, which was 4% for her interest payment, and we paid her 14% on the money we borrowed. So she was making 10% on money that wasn't even hers. So by being creative, we started to build our private lender base. To date, we have borrowed well over $10 million from private lenders, and that's the only way that we fuel our flipping business that does over 100 deals a year. And it's all funded through private lenders because I started with my very first one. So private lenders, yes, they put a mortgage on the property, but they are far easier to get. And once you get a private money lender, they don't check your credit, rarely. They don't evaluate the deals, rarely. They count on you to bring the information to them. All they want to do is get paid interest on their money. And once you get that set up, it becomes a text and the money is wired in. It literally becomes that simple if you build this business correctly. So the bottom line is, don't be tricked into thinking that a traditional mortgage is the only way to finance your flip. As a matter of fact, you might get in your first flip like that, but if you continue on and do more, it will only hinder you because they won't let you do any more after that. So get good at alternative ways of financing your deals. Before you stress about which type of mortgage to use, get really good at finding the right deal because the right deal will always bring you the money. People will knock down your doors to give you money on the right deal. So go watch my next video, the crucial step new investors always miss, where I'm going to break down exactly how to build out your buy box and several clever ways to finance your deals, ways that you've likely never even seen or thought about. Go check that out now. The link is in the description below.